This call is now being recorded.
Good morning, friends. Today we are going to take up some numerical problems uh, on the subject direct taxation and on the topic capital gains. So let's take the first problem. So before we do the problems, we should have a clear idea about the cost of inflation index. The cost of inflation index started was formed from the base year 2001 2002, and the base year cost of inflation index is 100, and every year the inflation is measured, and whatever is the inflation of a particular financial year is uh, recorded. So for 2001 2002 onwards till 2020-21 we have cost of inflation index stable, and we have to do the numerical problems based upon this inflation cost of inflation index table. So this table is very essential, very important to do numerical problems on capital gains under income tax 1961. So let's take the first example of a problem on capital gains. So this is a very comprehensive example which we discussed in the last class, but again I am taking up this particular numerical problem to make you understand the intricacies of this problem. So Mr. N.S. Mehta, who is the assessee, as of now completed construction of the ground floor of the building in on 1/1/1983 by spending amount of 15 lakh rupees. So this was the ground floor which was constructed on 1/1/1983 by spending 15 lakh rupees. Number one. Number two, he undertook completion construction of the first floor, and completed it on 1995. Sorry, and he spent around 20 lakhs. So till so far, for the construction of the ground floor and the first floor, Mr. N.S. Mehta has spent rupees 35 lakhs. So 15 lakhs plus 20 lakhs is 35 lakhs. But this, please remember, I told you any uh, cost of any improvement which has taken place before 2001 has to be ignored. This is the first point. Number two point is, if the asset has been acquired or constructed before 1/4/2001, then he has got two options: either to choose the cost of acquisition before 1/4/2001, as the case may be, or it will be given in the numerical problem the fair value of that asset on 1/4/2001. So whichever is higher, that is to be taken for the calculation of indexed cost of acquisition. So in this case, the fair market value of the house property on 1/4/2001 is given as 15 lakhs. So this house property fair market value 1/4/2001 is 50 lakhs. So this house property was in the form of ground floor and first floor, and the value of this ground floor and first floor amount spent was 35 lakh rupees, and the fair market value on 1/4/2001 was 50 lakh rupees. So higher among them is 50 lakh rupees. So this should be taken into consideration for the purpose of finding out the indexed cost of acquisition. So the cost of acquisition will be 50 lakh rupees, whichever will be the higher. Number one. So in place of 35 lakhs, 50 lakhs will be taken. So hope you have understood up to this stage of the problem. Next point. The next point is, he then took up the construction of the second floor. So already ground floor was there, second floor was there, and now this guy has taken construction of the third floor. Second floor, and completed the second floor construction on 1/2/2006. So please remember 1 to 2006 will fall under the financial year 2005-2006. So you have to find out indexed cost of acquisition, because at the end of the problem we'll come to know this is a long-term capital asset, and for long-term capital assets, majority of the times it should be indexed. So indexed cost of improvement will be done. So the cost of construction of the second floor is 30 lakh rupees. So to construct this second floor, you spent almost 30 lakh rupees. So this construction was taken place in the year 2005-2006. So please remember a valid point, a important point, a instrumental point, that any construction which has taken place before 1/4/2001 has to be ignored. However, any construction or repairs or improvement has taken place to the asset, it should after on or after 1/4/2001 has to be we have has to be taken into consideration for the computation of short term or long term capital gains. So this particular thing will be taken. So first ground floor and first floor are taken, and second floor also is taken. The fair market value of the house property on 1/4/2005. So 1/4/2006 it will be okay. So this will be, I'm changing it to 6. So here we had ground floor, we have first floor, and we have second floor. So the fair market value of these three house properties, having the house property which is having ground floor, first floor, and second floor, as on 1/4/2016, 2006 is 75 lakh rupees. Please remember, any fair market value given in the problem apart from 1/4/2001 should be ignored. So this should be ignored. Only whatever is the fair market value which is given on 1/4/2001 has to be taken into account. So this will be disregarded, will be ignored. Now, after the construction of this building having first floor, ground floor, and second floor, this guy N.S. Mehta has gifted the house property to Mr. S. Ramesh Kumar Mehta on 1/1/2007. This is very important. The date you can remember, which is in the year 2006-2007, which is in the year 2006-2007. Okay, now the father of S. Ramesh Kumar Mehta, who is N.S. Mehta, has gifted this building consisting of the ground floor, first floor, and second floor to his son S. Ramesh Kumar Mehta. So there is no valuation, there is no transfer as such, but it has been gifted. So there is no reason to compute long-term capital gains because there is no transfer. So just we have to remember these dates, on which date this particular house property was gifted. So it is in the year 2006-2007. This will be helpful in computation of index cost of acquisition. Okay. So next one. Now Mr. S. Ramesh Kumar Mehta took up the construction of the third floor of the house property on 1/2/2008, which will fall under 2007-2008. So in 2006-2007, he got the possession of the house property, but in the year 2007-2008, this guy constructed the third floor and he spent almost 50 lakh rupees. So this is we have to do indexed cost of acquisition. Indexed cost of acquisition. So 2005-2006 is the second floor, 2007-2008 is the third floor. You have to remember that. And 2006-2007 is the year in which this particular house property was gifted. So this is very important. 2005-2006 is second floor. 2007-2008 is the third floor constructed, because we have to find out indexed cost of improvement. Please remember that. Now, fair market value of the house property as on 1/4/2008. I told you already, any fair market value except for 0 on 1/4/2001 has to be ignored. So this also will be ignored. Now, Mr. S. Ramesh Kumar Mehta in the on 1/2/2020. So this will fall under the year 2019-2020. Sold the house property for 4 crores, which includes the ground floor, the first floor, the second floor, and the third floor. And all you have to remember this first floor as well as second floor as well as third floor and all the inclusive of the third floor. He has sold after 3 years on the date of acquisition or construction. Okay, so all this ground floor, first floor, second floor, and third floor are sold, uh, and it is sold after 36 months from the date of acquisition or construction. So all these assets are long-term capital assets, and hence you have to do indexation for improvements as well as acquisition, and you have to find out whether the assessee has incurred long-term capital gain or long-term capital loss. So in this case, please remember Mr. Ines Mehta is not the assessee. The person who is selling is S. Ramesh Kumar Mehta, who is the assessee, and they sold it for 4 crores. And there is a brokerage which has incurred in the process of selling the property, and the brokerage is 1% of the sale rate. From the given data, you have to compute long-term capital gain or long-term capital loss. So let's take up the problem. Let's take up the problem. For your convenience, what I did, I included in this particular table, in this particular slide, the cost of inflation index. So this is we have to remember the cost of inflation index of 2005, 2006, 2007, 2008, and 2006, 2007. Okay, 2005, 2006, 2006, 2007, 2007, 2008. Because third floor was constructed in this particular period. Second floor was constructed in this particular period, and in 2006, 2007 it was gifted. 2006, 2007 it was gifted to the assessee, who is Ramesh Kumar Mehta, his Ramesh Kumar Mehta, who is son. And please remember, this is the, oh sorry, 2009, 2020 you can take, it is 289. So this is 2009, 2019, 2020. This is the inflation index 289. This will be used for the purpose of solving the problem. So let's solve the problem. So the first, this is the format. Sales less expenses on sales or transfer will give you net consideration, and from this net consideration, whatever are the acquisition prices and the indexed improvements will be indexed and we deduct it to arrive at a long-term capital gain. So this is one part of our solution. This is the second part of our solution. This is the second part. This is the revenue and this is the expenditure. This is the income and this is the cost. This is a sales and this is the cost. So sales minus cost will give you profit. Will give you profit. Let's solve the problem. Let's solve the problem. Let's solve the problem. Now, first one is sales consideration. Already told it is 4 crores. So on this 4 crores is incurring 1% as brokerage charges, which is 4 lakh rupees. So from this 4 crores or 400 lakhs, deduct 4 lakhs and you will get 3 crores 96 lakhs as sale consideration, net sale consideration. Net sale consideration. Now let's talk about, so see, he has got the house property from his father on 2006 to in the year 2006 2007 2006 2007. So if we have to find out, the first one is index cost of acquisition, because this house property was acquired. So as this house property was acquired, see, in this case, if you remember, this house property, the first floor and the ground floor were constructed before 1/4/2001. So I told you, in such cases, as far as index cost of acquisition, where the date of acquisition of or construction of the house properties before 1/4/2001. If you want to find out indexed cost of acquisition is equal to cost of acquisition, that is 35 lakhs, or fair market value as on 1/4/2001, which is 15 lakhs, by by or next one is into uh, cost of inflation index. This is the cost of inflation index of the year of transfer. When was this uh, particular house property sold by the assessee? It was sold in 2019, 2020. So what is that index cost of acquisition? 289. So this is 289 by. Now remember, this is very, very important. It's not 2001, 2002, it should be taken as the bottom. But in case where the previous owner has passed down to the assessee his house properties or properties, then indexed cost of acquisition to be taken here in the bottom is the first time the assessee has become the owner. So in this case, the assessee become the owner in the year 2016-17, and the index cost of acquisition is 122. So you have to take in the bottom 222, 122, sorry. So if you in this two, 35 lakhs versus 50 lakhs, whichever is highest, so 50 lakhs into 289 by 122. So you will get index cost of acquisition. So index cost of acquisition is very, very important. So we have calculated index cost of acquisition is 1 crore 18 lakhs 44,262. So this is over. Now this particular house property was improvised by his father N.S. Mehta. So whosoever may be the person who is taking care of the improvement, it doesn't make sense. It doesn't make any difference. Still it has to be improvised. As I have told you, if any improvements have taken place before 1/4/2001, it should be ignored. But if any improvements are taken subsequent or on or after 1/4/2001, have to be taken into account. So this improvement was taken in the year 2005-2006, and it doesn't make any difference whether the assessee takes care of the improvement, or the previous owner takes care of the takes the takes part in the improvement of asset. So here in the year 2005-2006, it has improvised, and he spent an amount of 30 lakh rupees. So cost of improvement is equal to 30 lakh rupees, and the year in which it was improvised was 2005, and 2005-2006 the cost of inflation index is 2000 117, and this house property was sold in the year 2019-20, whose inflation index was 2089. So with this given data, we have to find out index cost of improvement, because this is not acquisition, this is improvement which has taken place. So index cost of improvement is equal to indexed cost of improvement index cost of improvement is equal to, please remember this is the formula. Index cost of improvement is equal to cost of improvement into CII, that is cost of inflation index of a year of transfer. So this will be always in the top, and cost of inflation index of the year in which improvement was taken place. So this is the general formula which have to use. So cost of improvement was 10 lakh 30 lakh rupees, sorry. Cost of inflation index of the year of transfer. So if you look here also 289, here also 289, also 289. So 289, because the house property was sold in the inclusive of first floor, ground floor, second floor, and third floor in the year 2008, 2009, and 2008, 2009. Sorry, 2009, 2010. The cost of inflation index is 289. Now you have to divide it by cost of inflation index of the year in which the cost of improvement has taken place. So you have to divide by 170. 117 is nothing but cost of inflation index of the year in which the improvement took place. So improvement took place as far as second floor is concerned in the year 2005-2006. If you remember, I showed you. So at that time the inflation index was 170. So 30 lakhs into 289 by 117 is equal to 74 lakhs 10,256. Next one. Now, in the similar fashion, you have to find out the cost of improvement to the house property as far as third floor is concerned. So, Mr. Assassi S. Ramesh Kumar Mehta undertook the construction of the third floor in the year 2008, and he spent almost 50 lakh rupees. So, we have to find out index cost of improvement. So, already I told the formula is equal to COII, that is cost of improvement into cost of inflation index of the year of transfer by cost of inflation index of year in which improvement took place. Improvement took place. This is the formula already told, took place. So this is cost of improvement of the third floor is 50 lakh rupees. cost of inflation index of the year of transfer is 289. Then you have to divide it by the year in which the improvement took place and its CII. So 2007 2008 was the year in which the improvement took place, and the cost of inflation index of 2007 2008 is 129. So divide by 129. So you will get 11 lakhs 20,1550. So hope you have understood all these items. If you have any doubts, you can ask me on my email ID, or you can call me on this on the number which I have shared on my slide, or you can just WhatsApp your query and I will help you in clearing your doubts. Now let's find out the long-term capital gain. So this is the sales. This is the sales calculation. This is the cost calculation. So this is the sales. This is the cost. So sales is 3 lakhs, 3 crore, sorry, 96 lakhs. What is the cost? 1 crore 18 lakhs, 74 lakhs, and 1 crore 12 lakhs. This is a first floor and ground floor. This is second floor, and this is third floor. So all these costs are put together 1 lakh, 1 crore 18 lakhs plus 74, 1 crore 92 lakhs, and it's almost 3 crore plus. So this is the cost, and this is the sales minus cost to this three put together. If you difference find out the difference, you will either get a profit or a loss. In this case, he got a profit of 91 lakhs 43,932, and this is a long-term capital gain because all these assets, first floor, ground floor, second floor, third floor, are sold after 3 years of acquisition or 3 years of construction. So on this he has to pay 20% as tax, which may be around 1 crore, 1 lakh, 18 lakh rupees. Sorry. Okay, if we invest this 91 lakhs in NHAI bonds or REC bonds, and one more bond is there. I'm not able to recall. If they invest this amount, total amount of 91 lakhs, then he is exempted from tax. However, if he invests partially, for example, 91 lakhs is the profit, he has invested 41 lakhs in NHA bonds, REC bonds. Then he has to pay tax on the remaining long-term capital gain, which is 50 lakh rupees. So this is the way you can plan for taxation. Or there is another provision that he if he acquires a house property 1 year prior to the sale of the property, or 2 years within 2 years from the sale of the house property, then he can, whatever is the cost incurred for the acquisition or construction of the house property, then that amount is exempted from tax, and the remaining amount is taxable. And there are some other conditions also in such a situation. Now, so this is the notes. So whatever I have discussed, this is the important notes which you have to note, which you have to take into consideration for solving the problem. So I told you fair market value of 2005 and 2018 should be ignored because only we are concerned about fair market value as on 2001. Number one, cost of acquisition shall be taken as cost of acquisition in the hands of the previous owner, or fair market value whichever is higher. However, this is very important. So in dono में से whichever is higher, cost of acquisition in the hands of the previous owner or fair market value as an 1/4 whichever is higher. And apart from this, however, indexation benefit shall be available from the year in which the assessee acquired the house property. In this case, Ramesh Kumar Mehta acquired the house property from his father in the form of gift in the year 2006-2007. So 2006-2007 will be the index year for cost of acquisition. Benefit of indexation in case of improvement incurred by the previous owner shall be available when the cost of so any improvements which were taken care of by the previous owner will be taken into account if such improvements are taken off one or after 1/4/2001. However, if the cost of improvement is taken place before 1/4/2001, which has to be ignored because this is already included in the fair market value, and we have found out the indexed cost of acquisition. So with this basic background of the discussion, as far as notes are concerned, hope you are able to solve the problem, and I hope you have understood the problem. In a nutshell, that is what again has come. So you can just have a glance on this particular slide. So summary. Please remember there are certain cases where indexation long will not be available, irrespective of the fact that that particular asset which is sold is a long-term capital asset. Okay, so these are some of them: debentures or bonds, slump sale. Some in case of slump sale also, we have a separate topic on slump sale where I am going to do a numerical problem. Okay, and certain other cases. Okay, if required, we will take up some problems at that time. We will find out whether long term on this long term capital gain, or sorry, long term capital asset indexation benefit is available or not. Now let's take a similar example, and we will do lot of we'll focus on doing some problems, and that will make you conversant as far as solving the problem is concerned. So Aishwarya Mehta has purchased a house property as on 27 to 2005. So 27 to 2005 will fall under, if you are correct, it will fall under this financial year, and whose cost of acquisition is 217. Sorry, 117, and she spent rupees 10 lakhs for construction of the house property. So this is the first part. On 1/6/2008, she constructed a new floor on the same house at a cost of 15 lakhs. So this is ground floor. This is the first floor. Ground floor was in the year 2005 2006, and she spent 10 lakh rupees. And now she constructed on the ground floor another floor. This is the first floor, and it was taken. The construction was completed in the year. So look, 1/6/2008. It will fall under 2008 2009. 2008 2009. So 2008 2009. You should know what is the cost of inflation index, and she spent 15 lakhs. Now she sold after almost 14 or 10 years, or 11 14 in this case, and 11 years in this case, in the year 2019 2020, this house property which was on 1/8 2019. So 1/8 2019 means 1920, and inflation index of 2019-20, already I told you, you have to remember, because we are going to solve the problems on the basis of 2018-2019. In this 2019-2020, the inflation cost of inflation index is 289. So with this given data, and she realized 28 lakhs, sorry, 80 lakhs, and she paid a brokerage of 3% on this particular transaction. So with this given data, you have to find out the cost of index cost of improvement, the index cost of acquisition, the net sale value, the net sale consideration, and the long-term capital gain. Because in this case, I told you it is sold after 3 years from the date of acquisition or construction, and hence it is a case of long-term capital gain. So let's solve the problem. So as already told, this is one part of the problem, and this is other part of the problem. So this is the sales, and this is the cost. Sales minus cost will give you profit. Sales minus cost will give you profit. Sales minus cost will give you profit. So let's solve the problem. Sale consideration is sale consideration sale consideration is 80 lakh rupees. So expenses on transfer is 3% on 80 lakh rupees, which is 2 lakh 40,000. So net sale consideration is 77 lakhs 60,000 rupees. So up to this stage, this is okay. Now first floor and sorry, ground floor and first floor. So this is improvement. This is cost of construction. So first we have to find out the cost of construction or cost of acquisition of the ground floor, and next you have to find out indexed cost of improvement of the first floor. So let's solve the problem. Let's solve the problem as far as finding out index cost of construction or acquisition, and subsequently index cost of improvement. So I told you in the index cost of acquisition is given by the formula cost of acquisition into CII of the year of transfer by CII of the year of construction. Okay, so if it is one before 1/4/2001, I told you the formula, but this is the case of on or after 2001 the house property was constructed. So CA of the year of construction. So cost of acquisition was 10 lakh rupees, if you remember, into CII of the year of transfer in which year it was transferred in the year 2019-20, and the sale at the time the CI was 289. So 289 divided by CI of the year of construction. So the construction took place in 2005, 2006, 2005, 2006, whose cost of inflation index is to 117. So divide by 117, you will get 24 lakh 70,885. So you have cleared up to this stage. Next, so we have taken care of the ground floor. Now we have to do the index cost of improvement of the first floor, because first floor was constructed by some spending such amount on improvement. So index cost of improvement, as already told, is equal to cost of improvement into this particular house, second floor, first floor also sold in the year 2018-19. Sorry, 2019-20. Hence, CII of the year of transfer, that is 289. Okay, by CII of the year in which the construction was the improvement was taken place. CII of the year in which the improvement was taken place. So improvement was taken place in the year 2008 2009, 2008 2009, and 2008 2009 the indexed sorry, cost of inflation index is 137, is 137. So with this given data, let's calculate index cost of improvement. So cost of improvement by CA of the year of the transfer by CA of the year in which the improvement took place, which is 137. If you calculate, you will get 31 lakhs 64,234. So hope you understood this part also. So what we have done, we have done three calculations. So one is net sale consideration, index cost of acquisition, and index cost of improvement. So this is cost. So this is the sales or revenue, and this is the cost. So the cost is 24 lakhs 70,000 and 31 lakhs. So roughly around 57, 6 lakhs, something like that. So this is the realization value, and this is the cost. So if you find out the difference of these two, 77 lakhs minus 24 lakhs minus 31 lakhs or 32 lakhs approximately, it will give a long-term capital gain of 21 lakhs 25,681. So long-term capital gain is equal to 21 lakhs 25,681. On this, you have to pay 20 percentage long-term capital gain tax, or there is another option of investing the whole amount in NHAI bonds, that is National Highway Authority of India government undertaking, or REC, that is Rural Electrification Program, Rural Electrification Corporation of India, again a government undertaking. In these companies float bonds, and if you invest this amount, you will get deduction. If you invest only 15 lakhs, then you will get a long-term capital gain deduction of 15 lakh rupees, and the difference of 6 lakhs 25,680 will be long-term capital gain. And the other option is house is constructed 1 year prior to the sale date of sale, or one you are purchased or constructed a house property within 2 years from the date of sale of such amount, then it is exempted from tax. Now let's take up the third numerical problem of the day. Let's take up the third numerical problem of the day. This is very important problem. So please pay attention. So the assessee is S. Ramesh Kumar Mehta, who furnishes the following data for the previous year 2019-20 about the sale of assets which he has undertaken. So compute the capital gains for the assessment year 2019-20. So he has sold land, again he has sold land, again he has in the same year he sold debentures, and he has sold gold. So please remember, land is a long-term, is a asset. This is a asset. This is also asset. This is also asset. So when you are selling asset, it is subjected to capital gains. Number one. Number two, whether it is transferred, yes, it is given that he has sold. So first condition is sale of capital assets. Next is transfer. Now the question arises whether it is a long-term asset or short-term capital asset. So in this case, he has, as far as land is concerned, he has acquired in 1999 and sold in 2019-20. So it is a long-term capital asset. So this is a long-term capital asset. In the same way, 1999, the second land was purchased and sold in 2019-20. So this is also a long-term capital asset. Whereas let's talk about debentures. For debentures, it is 12 months. Remember that if he has sold within 12 months, then it is short-term capital asset. If it is sold after 12 months, then long-term capital asset. So this is also a long-term capital asset. Gold also, it seems to be a long-term capital asset. However, this you will get the opportunity of you can take the help of a long indexation. You can do indexation because long-term capital assets, in particular land, we can do indexation. Land we can do indexation, but debentures, I told you in the previous. So here, if you look, indexation is not available for debentures or bonds or slum sales. So in this case, you will not be given the option of executing indexation of the asset because despite the fact this is a long-term capital asset, indexation is not allowed. Gold, yes, long-term capital asset, it can be indexed. We can opt for indexation. Number one. Number two. Now, please, I'm giving you the basic and the full understanding of the topic of the numerical problem. Okay, so in this case, it is purchased before 1/4/1991. So certainly you should be given this particular problem should have the data as far as the fair market value of this particular land on 1/4/2001. 1/4/2001. So in this, the data of acquisition of 1/4/1999. So fair market value should be given, and it is given. So now cost of acquisition is 15 lakhs and fair market value as on 1/4/2001 was 35 lakhs. So among them, whichever is higher, the benefit of indexation is to be taken. So 35 lakhs will be taken as cost of acquisition. So hope you have understood this point. Next one. Next one is um, land. 70 lakhs was the sales proceed. The cost of acquisition was 20 lakhs. And remember, this is also a asset which was purchased before 1/4/2001. So certainly this particular problem should give data as far as 1/4. Uh, it should give the fair market value as on 1/4/2001. 1/4/2001. So it is given as 15 lakhs. So now remember, among these two, whichever is higher. So in this case, the fair market value is lesser than the cost of acquisition. So for the purpose of index cost of acquisition, we will take this one and not this one. Now debentures, 12 lakhs was the sales price. The cost price was 2 lakhs. The fair market value was 4 lakhs, and it was purchased on 1/4/2011. So fair market value doesn't have place because we have to take into consideration because he has purchased this on 1/4/2012. So the fair market value of 1/4/2001 will not come into picture. And this is also not required. This is also not required because please remember, on in case of debentures, there is no indexation. So the simple rule is the cost price minus the sales minus cost price. So we'll see whether we should take 4 lakhs or 2 lakhs. But the fair market value is of as on 1/4/2001 is 4 lakh rupees. So we will not consider this because the asset was acquired on 1/4/2012. Next one, gold. So gold was purchased for 20 lakh rupees. So sold for 20 lakh rupees, which was purchased on 1/4/2006 at 50,000 rupees. And this is eligible for indexation, but the fair market value of 1/4/2001 is given, so it doesn't have place in the formula because the cost of acquisition was in the year 2006-2007. So with this particular background, let's solve the problem. Very important problem. We can be expecting a question on this particular in similar fashion. You can have a problem of this similar kind. So let's solve the problem. Let's solve the problem. So first one is land B, debentures and bonds. So let's do one by one. So sale consideration was 60 lakhs. Sale consideration was 60 lakhs. Now we have to do index cost of acquisition. So index cost of acquisition, as I already told, among these two, whichever is higher, which is 20 lakhs. So index cost of acquisition is equal to cost of acquisition into year of cost of inflation index of the year of transfer by there is no previous owner, so it's not the formula becomes cost of inflation index, cost of acquisition into cost of inflation index of the year of transfer by CII of the year in which it was acquired. But acquired is in the year 1999, 2000. So for these cases, you have to take the cost of inflation index of 2001, 2002, because fair market value will be given. So it is 20 lakhs cost of acquisition. Sorry, among these two, whichever is highest, 20 lakhs into year of transfer is 289 by CAA of the year of fair market value, that is of 1/4 2001, that is 2001 2002 is 100. So 57 lakhs 80,000 is the long term capital, sorry, is the cost of index cost of acquisition, cost of acquisition. So 60 lakhs minus 57 lakhs 80,000, the difference is 2 lakhs 20,000, which is long term capital gain. So hope you have understood this one. So the problem is maybe having so many differences in comparison with the previous problem. So you have to appropriately and sensibly use the formulas based upon the situation. So sale consideration of the second house property was 70 lakhs. Now indexed cost of acquisition, because there is no improvement, so we will not go for improvement. So this acquired property was on 8/4/2019, 1999, sorry. So in such a case, cost of acquisition or fair market value of 1/4/2001, whichever is higher, should be considered as cost of acquisition. So this is cost of acquisition higher into the year of transfer, and fair market value is taken. So what is the fair market value 2001 2002? So what is the cost of inflation index? It is 100. So 2 lakh 20 lakhs into 289 by 100 is equal to 58 lakhs 80,000. So 70 lakhs minus 58 lakhs 80,000 will give you 11 lakhs 20,000 long term capital gain. So you have to pay 20% tax on this one, 20% tax on this one. But if at all there is a long term capital loss, you can reduce long term capital loss from these two long term capital gains. Now let's look at debentures. So debentures, there is no question of indexation. So the debentures sales is 12 lakhs uh, minus cost of acquisition. In this case, 20 lakhs versus 2 lakhs versus 4 lakhs, whichever is highest. Okay, so here if I will change it to 1998. Okay, so 4 lakh rupees. Okay, so the cost is 4 lakhs, because among these two, whichever is highest. So it will be 8 lakh rupees will be the profit. 8 lakhs will be the long term capital gain. The same way gold. So this also it is 1996. I will consider. So in this case, 1996 the cost was 50,000, and the fair market value, because 1996 is given. So how to compare cost of acquisition with fair market value, whichever is higher. So it is 50 lakhs, 15 lakhs. Okay, small minor correction. Okay, let's keep it as 2006 only. So 15 lakhs into now this is 2006 2007. So 2006 2007 this is 122. So 1 lakh 50,000 into year of transfer CAA by CA of the year of purchase. So 1 lakh 50,000 into 289 by 122 is equal to 3 lakh 55,000 328. So 20 lakhs was the sale consideration, and the cost was 3 lakh 55,000, and then the profit is 16 lakhs 44,677 as far as long term capital gain is concerned. Now let's take the fourth problem. So the problem goes like this. Mr. Raja purchased a piece of land in May 2004 for 84,000 and sold the same in April 2020, that is 2009 2020. And this was in the year 2004 2005. Purchases was done in the year 2004 2005. So 2004 2005, the cost of inflation index is 113. So that is the reason why it is to be converted to CIA. What will be the taxable capital gains in the hands of Mr. Raja? So sale consideration is 10 lakhs 10,000. brokerage charges is 10,000. So effective sales is 10 lakh rupees. So this is one part. Now, cost of acquisition, index cost of acquisition. So this is not a case of 1/4/2000 before 1/4/2001, but this is a case of asset purchased on or after 1/4/2001. That is in the year 2004-2005. Okay. So in this case, index cost of acquisition. Why index has to be done? Because first we have to find out whether it is a long-term capital gain asset or a short-term capital asset. So 2004 was the purchase year, and 2019 is the sale of asset year. So it is almost 15 years, more than 36 months. So it is a case of long-term capital asset. So indexation can be given. Indexation provision is there for an asset which is a piece of land which was sold. So index cost of acquisition is equal to cost of acquisition into CI of the year of transfer by CI of the year of acquisition. So this is the formula. So let's take the solution. So COE, cost of acquisition, is 84,000. CI of the year of transfer. So it is transferred in the year 2021. This is 2021. So 2021. So 2021, 1920 is 289, and 2021 the inflation index is 301. So 301, 301 by the cost of inflation index of the year of acquisition. The asset was acquired in the year 2004-2005. So 2004-2005, it is 113. So this is what is the way you can solve it. So 84,000 into 301 by 113 is equal to 2 lakhs 23,752. So the cost price is 2 lakhs 23,752. The selling price is 10 lakhs, and eventually here there is no improvement. So improvement is nil. If at all improvement is there, then cost of index cost of improvement or cost of improvement should be calculated. So the long-term capital gain in this case, as well as sale of land, is equal to 7,76,248. Now let's take the fourth or fifth numerical problem of the day. Let's solve the problem. Mr. S. Ramesh Kumar Mehta, whose age is 57 years, is a retired person. So it can't be a case of retired person. So let's okay. It doesn't make any difference. We'll solve the problem. He purchased a piece of building or land in December 2011. So it will be in the year 2011, 2012, financial year 2011. So you have to find out the CAA because this is a purchase year, and sold the same in 2000 April 19. So this is a case of sold sale in 2020-21. So already we have sold. We have seen the inflation index is 30301. So this is 301. 301. Please remember that. Taxable long-term capital gain on such a sale amounted to rupees 6 lakhs. Okay, from this sale, he got a long-term capital gain of 6 lakh rupees. Now, see, there are no cost of acquisitions given in the problem, neither the selling price, the sale consideration is given. But however, the problem directly tells that the long-term capital gain on such sale is rupees 6 lakhs. So he has to pay on this 6 lakh rupees 20% long-term capital gain, or other provision is purchase a house property of similar nature. Sorry, this is a case of land within 1 year before the sale or within 2 years after from the date of sale. Okay. So apart from gain on the sale of land, he invested deposits of 1 lakh in public provident fund and rupees 50,000 in NSC, and he wants to claim 1.5 lakhs under section 80C. So there is a separate video which I have prepared on section 80C exam deductions under the list of items which are considered for deductions under section 80C. So you can visit my YouTube video on that particular topic, and you can understand the deductions under section 80C to 80U. And I have done some numerical problems on salary income, and in those problems I have included some deduction elements of section 80C to 80U. So you can visit that. But in this case, this is a case of long-term capital gain, which is 60 lakh rupees. And please remember, Deductions under section 80C to 80U and LTG. There is no deductions from tax under section 80C to 80U is allowed for long-term capital gains. So on the 6 lakh rupees he has to pay tax. He can't claim he can't state that that I have invested in section 80C 1.5 lakh rupees. So give me exemption of 1.5 lakh rupees and I will pay tax long-term capital gain on 4.5 lakhs rupees. No, there is no provision as such under income tax rules of 1961. So this is the way. So long-term capital gains is 60 lakh rupees, 6 lakh rupees. So income from salary, house property, short-term capital gains, income from business, income from other source, etc., are zero. So the gross total income is gross total income is nil, and so the gross total income becomes 6 lakhs. Sorry, deductions under section 80C to 80U as there is a long-term capital gain, and as already told, you can't deduct any amount under section 80C to 80U when you have long-term capital gain. So nil. So your total income becomes 6 lakh rupees. Now he can claim the basic exemption of 2.5 lakh rupees. I told you there is a separate video which is prepared on tax slabs and rates and tax amount to be paid. So in this case, from 0 to 2.5 lakhs, it is nil. So he will get an exemption of 2.5 lakh rupees, and on the remaining 3.5 lakh rupees, he has to pay 20% towards long-term capital gain and higher and education cess of 4%. So 3.5 lakh rupees into 20% is equal to 70,000 rupees plus 4 percentage on this one towards secondary higher education cess, which is 72,800, because this 4% is 2,800. So this is the meaning of section importance of section 80C to 80U. Let's take one more example, and this example I have taken it from a prominent book on income tax by Kapil Singhania and Monica Singhania of Taxman. So this is a standard disclosure I have to do. So let's solve the problem. Let's solve the problem. So so for this solving the problem, I require this table. This table is required. So this table is required. So we will use this table to solve the problem. However, you can just remember, if at all, if you want to remember the indexation, cost of inflation index. Lucky has a house property acquired on 18 8 18 2009. So this is 2009 2010 for rupees 6 lakhs. He used the house property for his own residential house purpose. On 18 2012, that is in the year 2012 2013, he expended some money for construction of the house property, and this is the cost of acquisition, this is the cost of improvement, and the year of improvement and year of acquisition, 3 lakh rupees. Now on 15/5 2018, he brought the whole office goods inflammable worth rupees at home to be delivered to a party staying near to him. Okay, he brought some inflammable goods, something like that. At the night of that day, accident took place and the damage the whole property, furniture worth 5 lakh rupees and business stock. Okay, so this data is given to us. Insurance claim on 1/18/2000. So for the house, 1 lakh rupees in cash and new house allotted to him, something like that. So this will, I think this is a problem which is related to, let's solve the problem. Sale consideration. Sale consideration is, so he, for the house property, 1 lakh rupees in cash, insurance received 1 lakh rupees in cash, and new house allotted 44 lakhs. So this is the sale consideration. What is the amount expended? The amount expended was on the first floor 6 lakh rupees. So cost of acquisition and cost of improvement. So on the ground floor 6 lakh rupees, and the house accident took place in the year 2018-19. So 2018-19 is a sale year, because the insurance company is giving the sale consideration. So 6 lakhs into, that is the cost of acquisition, into inflation index of the year of transfer, even though there is no transfer, but as there is a fire which took place in the year 2018-19, and subsequently the insurance company is paying money towards that insurance to 180 divided by 2009 2010. What is the inflation index? Let's look at the inflation index of 2009 2010. So to my knowledge, it will be 148. So it is 148. So 148. So 148. Now this is index cost of acquisition 11 lakhs 35,000. Number two is he also undertook improvement, and that was the cost. So 3 lakhs into year of transfer, that is 2018-19 to 80. By when was inflation? The construction took place 2012 2013. So let's look at 12,000, 2013. It is 200. So 200. So 4 lakhs 20,000 rupees. 4 lakhs 20,000 rupees. So 45 lakhs is the total income. These are the total cost, that is index cost of acquisition and index cost of improvement. So the total cost of index cost of acquisition and index cost of improvement is 15 lakhs 55,135. So he made a profit of 29 lakh 44,865, on which he has to pay long-term capital gain tax. So this is, now let's take a small numerical problem uh, on capital gain on conversion of debentures into shares. So there are so many assets which are going to be dealt under the head income from capital gains. So many assets. So now we are talking about the, so till so far we have taken discussed on assets like land, building, gold, etc., etc. Now plant, etc. And now we are going to talk about uh, debenture conversion, capital gain on conversion of debentures into shares. For example, there is something called as convertible debentures. So we have to know the basic concept of convertible debentures. Convertible debentures are those debentures which will be converted into equity shares on a predetermined day based upon some terms and conditions. So that is the meaning of it. So previously it was a debenture which was an asset. Now this was converted by virtue of the nature of the debenture, which is convertible debentures, into convertible equity shares. So debentures are converted into equity shares. So for example, I have purchased 1 lakh rupees of debentures. I have invested in 1 lakh rupees of I invested in debentures of 1 lakh rupees. Now until so far, like 3 years, 4 years, I'm going to get interest, and on the completion of the maturity, it will be converted partly or otherwise fully. So for example, in this case, it is the whole amount of 1 lakh is converted into shares at, for example, 450 shares of that company. So this is the cost of acquisition. Now however, these are converted into sales, into equity shares, and after some time from the date of conversion, I sold it for 5,000 rupees. So this is the sale price, this is the cost price, and we have to find out the holding period. That is the meaning of conversion of debentures into shares. So again, I am telling you one important, the background of the topic, because the background of the topic is very important in understanding or solving the problem, without which you can't move further. Which, so let's take a note of it. So for example, I invested in Reliance Industries debentures 1 lakh rupees, 1 lakh rupees in the year 2010. Okay. Now in the year 2019, sorry, 2015, for example, this was converted into shares. This 1 lakh rupees on the maturity were converted into shares, and the number of shares I got was 5,000 rupees, 5,000 shares. Number one. Number two. So this is the debenture amounts. This is the date on which it were converted into shares, and in the year 2019-20 or any other year, it is sold. These shares are sold, not debentures, because debentures are already converted. So 2019-20, I have converted. I wanted to sell, or the associate has sold. So and here he sold these 5,000 shares each at some amount, and he got 2.5 crores. Now, so this is the cost of acquisition of debentures. This is the sales of transfer on realization of shares. Now we don't know. We have to find out the holding period, and so on and so forth. So with this background, let's take up the critical discussion of this particular asset, which is conversion of debentures or bonds into shares, or that is equity shares. Please remember now, very important, conversion of debentures, including debenture stock and deposit certificates, into shares or debentures, okay, are not treated as transfer because he has not told they have automatically got transferred into shares. Tax impact on sale of such converted shares will be as under cost of acquisition, cost of old asset, that is convertible debenture. So I told you 1 lakh rupees is the cost of acquisition. Now, what is the holding period? Whether it should be holding period from the date on purchase of debentures or date of sales of equity shares or conversion of debentures into equity shares, that date to sale of shares that date. So, is this the holding period or is this the holding period? So, holding period starts from the date of acquisition of debentures. So, this is the date of starting and this is the date of end, that is the date of sale. So this duration has to be taken into account to find the holding period. So this is also clear. Now indexation benefit. Indexation benefit shall be available from the date of allotment of new asset. So indexation will be available to the shares, but from which year onwards? From the year in which it has been converted. No indexation is applicable in case of debentures. So another case. So in the later part of our discussion, we are going to take up some small numerical problems on individual assets like conversion of debentures into equity shares, so on and so forth. Now let's take another discussion. Capital gains on transfer of shares of amalgamating company in lieu of amalgamated company. So in lieu of means in place of amalgamated company. So there are two companies: amalgamated company, amalgamated company, and amalgamating company, amalgamating company. Okay, now let's talk about what this particular slide is speaking about. For example, Mr. S. Ramesh Kumar Mehta had some shares in this company. For example, 5,000 shares of amalgamated company. For example, it is ABC. So ABC Limited, SRK Mehta has got 5,000 shares. But this company got amalgamated into this company. So these shares will vanish, and to the shareholders of this company, to the previous shareholders of this company will give shares in a particular ratio. For example, in this ratio, in this case, amalgamating company is giving to these shareholders of amalgamated company two shares for one share. Means if you possess one share, you are going to get two shares. So in this case, how many shares you originally possessed in the amalgamated company? 5,000 shares. So you will get two shares for one share held. So you will get 10,000 shares. Okay, that is the meaning of amalgamated and amalgamating company. For shares held in amalgamated company, you are going to get shares of amalgamating company. So hope the basic background is understood. So in this case, I want to find out these three aspects: cost of acquisition, determination of the nature of the asset, and all that stuff. Any shares of a, that is I will call it as period of holding, because if the period of holding is more than 3 years, LTCG, LTCA. If it is less than 4 years, 3 years, sorry, it is STCA. So it will come, by this period of holding we'll come to know whether it is a short-term capital gain or a long-term capital gain. That's the asset or a short-term capital asset. So let's talk about these aspects before solving the problem. We have got a beautiful example also for solving the problem. So don't worry. So let's take a look at the provisions. Let's look at some more provisions. Okay. Cost of shares in the amalgamated company. The cost of shares in the amalgamating company shall be deemed to be the cost of shares in the amalgamated company. Okay. So previously, whatever you have purchased, that will be the cost of the shares. De- Determine the nature of the asset. To find whether the shares in the amalgamated company are long term or short term, the period of holding shall be calculated from the date when the shares in the amalgamating company were acquired. Okay, we'll see the problem. And indexation shall be available from the year in which the shares were amalgamated company were acquired by the assessee. So let's take some numerical problem, and this numerical problem will help us to solve the solution to amalgamating and amalgamated companies. So S. Ramesh Kumar Mehta has 5,000 equity shares of ABC Paint Limited. So SRK Mehta has 5,000 shares, equity shares, okay, which are traded on National Stock Exchange or Bombay Stock Exchange or any national, any regional stock exchanges. And this were acquired through his through on 27 9 2006, that is in the financial year 2006 2007, just you remember this one, and through the will of his father. So father has through the will, uh, this guy has inherited these assets or equity shares through will or inheritance from his father, S Mehta. However, okay, Mr. N.S. Mehta has acquired such shares on 2000. This father has acquired these shares on 4 2000, 24/10/2003 through the will from his father. So this is the father of uh, S. Ramesh Kumar Mehta. His father is N.S. Mehta. N.S. Mehta acquired on these shares on 1/24/10/2003 from his father N. Mehta, and N. Mehta acquired the house these shares on 1 to 1912 to 1998 for rupees 200 each. Okay, so from N.S. Mehta to N. Mehta, from N. Mehta to N.S. Mehta, and from N.S. Mehta to S. Ramesh Kumar Mehta, 5,000 shares. Now, as these shares were acquired by the first two owner in the year 1998-99, so fair market value should be given, and it is given. So this person has acquired on 1912 to 1998 for 200 rupees, but the fair market value is also given, and it should be given, and it is 01/04/2001 for 250 rupees. So the cost of acquisition in the hands of S. Ramesh Kumar Mehta, because S. Ramesh Kumar Mehta is the subject matter or the assessee who is going to sell the product, the property in the form of equity shares. So this or this, whichever is highest, so this will be, and these two fair market values. So this fair market value and this fair market value should not be taken into account. I already told any fair market value apart from 01/04/2001 should be ignored. So hope you have understood the discussion part of this particular problem till so far. Now, what has happened subsequently in 2014, that is on 01 August 2014. So this guy became the owner in 2006, but he has observed that this company ABC Painted Limited amalgamated with the XYZ Painting Limited. Okay, so this got amalgamated in this company. So ultimately, the shares will be renounced and it has to be surrendered. And this guy is going to give his shares to the shareholders of ABC Private Limited in a fixed proportion or a pre announced ratio. So in this case, it's two equity shares for every one share of amalgamating company. So this is the amalgamating company. This is the amalgamated company. So this shares will be given to this company, and he will renounce these companies in favor of ABC Limited, ABC, XYZ Paint Limited. So for every two shares held in ABC Limited, sorry, for every one share held in ABC Limited, you are going to get two shares. So this guy has already got 9,000 shares. So for one share, he is going to get two shares of the now subject matter company, which is XYZ Limited. Okay, now it is assumed that he is going to get 10,000 shares of. So he has previously 5,000 shares, and for every one share, he is going to get two shares. So he will get two shares of XYZ Limited, right? XYZ Paint Limited. Now look at this. 14 was the year in which it was converted, and in the year 2019-20, he sold each share 10,000 shares for 50,000 500 rupees in the stock market, and he sold this with a transfer expense of 2%. With the given calculations, you have to find out whether it's a long-term capital asset, what is the long-term capital gain, if at all if it is a long-term capital asset. Well, let's do the problem. Let's do the problem. Very important problem. So let's solve the problem. So first and foremost, we have to divide our discussion into many parts. When any shares become the property of the assessee in the scheme of amalgamation, the period of holding in amalgamated company shall be aggregate period of holding of shares in the amalgamating company prior to amalgamation and period of holding of the shares in the. So it means that in this case 1998 was the year in which they invested in ABC Limited, and this got converted in shares got converted to into XYZ Limited company. So and he sold it in 2019. So the period of holding is not 2014 on the day in which they were converted, but from the date on which they were originally acquiring the previous company shares. So it is from 1998 because previous owners holding period or cost of date of acquisition should be considered. So 1912, 1988 will be considered as this discussion is concerned. Hence, in this case, asset transferred being of a XYZ Print Limited company will be treated as long-term capital asset. Now, cost of acquisition. What is the cost of acquisition? Certainly, his grandfather purchased it at. So I told you this. The grandfather acquired on this date, that is 1998, 200 rupees. But when it is before 1/4/2001 is the acquisition date, then they will give you the fair market value on 1/4/2001. So the fair market value is 250. So you have to consider among these two whichever is the highest. So it is 250 rupees. So 5,000 into 250 rupees is equal to 2,50,000. So this is also clear if I'm okay. Now, so the total money spent on acquisition of shares is 12,50,000 rupees. Now, this guy got 5,000 shares of the previous company ABC Limited, and subsequently they were converted into XYZ Limited company because of a scheme of amalgamation. So for every 5,000 shares, he is going to get 20, for one share, one share held, he will get two shares of the amalgamating company. So he will get 10,000 shares of XYZ Private Limited. So 10,000 shares. Now we will find out the cost of acquisition of each share of XYZ Private Limited. So the cost of acquisition was 12,50,000. Number of shares were 10,000. So the cost of acquisition per share of XYZ Limited is 125. So this is number fourth. Number five, previous owner means the last owner who acquired the asset for a value. In this case, S. Ramesh Kumar Mehta acquired the shares through his will of his father. Hence, literally, S. Ramesh Kumar Mehta's father, N.S. Mehta, is the previous owner. But since S. Ramesh Kumar's father, Mr. S. Mehta, has not purchased such shares, but acquired by way of will from his father, N.S. Mehta. Hence, for this purpose, Mr. S. Mehta is the previous owner. So, what it means to say is neither his father, neither S. Ramesh Kumar Mehta are the previous owners, but S. Ramesh Kumar Mehta's grandfather, who is S. Mehta in this case, is the previous owner. So, hope you have understood it. Now, let's calculate the amount of capital gain. And as the asset is a long-term capital asset, and uh, the asset is a long-term capital asset, we will find out whether it is a case of long-term capital gain or a short-term capital gain. So, now please remember 10,000 shares of XYZ Limited were there, and this guy sold it for 500 rupees. If you are able to see this, this is the selling price on some date of 2019, 2020. So 10,000 shares are sold at 500 rupees each. So 50,000 rupees is net consideration, and it is given in the problem. 2% is the brokerage charges. So 1 lakh rupees. So net sale consideration is 49 lakh rupees. So this part is also over. There is no cost of improvement for shares. There is no improvement as such. Now, index cost of acquisition. So, already told in the previous slide, the total cost of acquisition is 12,50,000 rupees. So, 12,50,000 rupees into the year in which this particular asset was sold. So, cost of acquisition formula. Now, take the formula. Index cost of acquisition is equal to cost of acquisition, which is already done in the previous problem, previous slide. This is the cost of acquisition into CII of the year of transfer. It has been transferred in the year 2019-20, whose inflation index is 289. So 12 lakh 50,000 into 289 so far. Divided by CA of the year of acquisition. Please remember, the assessee for the first time got the possession of shares. Now look here. In which year you got the possession of shares? The assessee is Ramesh Kumar Mehta. He got in the year 2006, 2007. So that should be taken at the at the bottom, at the denominator, here. That is the cost of inflation index, sorry, CAI is 240 is the year of amalgamation. In which year it has got amalgamated, that has to be taken into account. So this is a small and important information. So please remember, in this particular case, the amalgamation took place in the year 2014, 2015. And let's look at 2014-15. What is the index cost of acquisition? Sorry, CII of the year of 2014-15. So 2014-15, if you look, it is 240. 240. So when did the amalgamation take place? That is the year in which the cost of inflation index has to be taken. So 1 lakh 12 lakh 50,000 into 289 by 240. By 240. So you'll get 15 lakhs 5,208, the cost of acquisition. So if you deduct from 49 lakhs 15 lakhs, you will get the long-term capital gain of 33 lakhs 94,799 792. So this is the way you have to solve the problems in such cases where uh, now let's take up another problem on slump sale. So we will understand the basic concept of slump sale. We will understand the concept of slump sale. Slump sale means, so there can be some instances where slump sales comes into picture, and at that time you should be in a position to understand the concept of uh, uh, slump sale. Some slump sale means the transfer of one or more undertakings for a lump sum consideration without assigning values to the individual assets. For example, there are a particular company has got three manufacturing undertakings, A, B, C. So out of these three, two undertakings are sold. See, when they are selling, they may be having land, building, plant and machinery, furniture, debtors, etc., etc. B undertaking also got similar kind of assets, but they have not find out the value of these assets, but they have sold in a lump sum. This is called as a slump sale of a particular asset. Slump sale we call it. So undertaking shall include. What do you mean by undertaking? What do you mean by undertaking? Undertaking shall include any part of an undertaking or a unit or a division or any other things. Okay, so just you can have a glance at this particular part of our slide for understanding the meaning of undertaking. So we will take a small numerical problem. In this case, please remember there are some important points to be noted and to solve the problem. So before we go into the problem, we have to understand some basic elements. So sale consideration is as usual. There is no cost of acquisition or net worth. Cost of acquisition or improvement is net worth of the undertaking. We have a definition for net worth also. We'll see what is net worth of the company. Nature of the gain, whether it is a short-term capital gain or a long-term capital gain. If undertaking is owned and held by the assessee for not more than 36 months, then the capital gain will be short-term capital gain. Where an undertaking is owned by the assessee for more than 36 months, then it is treated as a long-term capital gain. It makes no difference that few of the assets of the undertaking are newly acquired. For example, if assets are newly acquired and they are sold, but there is a slump sale which includes both categories, old as well as new, it doesn't make a difference. So if it is 36 months less than, the undertaking is less than 36 months, then it is a short-term capital asset. If it is the undertaking is more than 36 months, you should not take into account the individual items of capital assets which are sold and the age. So the undertaking age has to be taken. If it is greater than 36 months, it is a long-term capital asset. This is short-term and this is long-term capital asset. Now, how do you find out the net worth of the company? Because the net worth of the company is the cost of acquisition. So the net worth of the undertaking is aggregate value of all the assets. When we take up a numerical problem at the time, we will understand what do you mean by aggregate value of such total assets of undertaking minus value of liabilities of such undertaking as appeared in the books of account. So aggregate value of total assets minus aggregate value of total liabilities will give you the net worth of the company. And very important, you have to take a very serious note or observation on this particular slide. So in this case, the aggregate value of total assets. Here, the aggregate, I'm mentioning the word aggregate value of the total assets minus the total. So assets minus liabilities is the fundamental answer to your net worth. Assets minus liabilities is equal to net worth. Now, for example, you got some, for example, land, building, plant and machinery, cash, debtors, excess stock, and the worth of all these assets is 5,000 crores. So your net worth is 5,000 crores, but you have to pay to bank for loan taken, to debenture holders, to preference shareholders, so on and so forth, some 4,500 crores. So your net worth is not 5,000 crores. From this 4,000, 5,000 crores, you have to deduct 4,500 crores to arrive at the net worth. So say net worth is nothing but simple assets minus liabilities. Assets minus liabilities. The value of assets minus the book value of the liabilities. Now, how do I find out the aggregate value of the total assets? So again, this will be highly used. This will all be highly used in case of solving at the time when we are solving the problem. So in case of depreciable assets, the value of the assets should be taken as WDV of the block of the asset. So there is a separate chapter, income from business, and the income from business. Under income from business, we find out depreciation under section 32. At the time of the discussion, I told you what do you mean by WDO of the block of assets. So you can refer my video on income from business, where block of assets and WDV and depreciation is mentioned. Okay. Now next one is capital assets in respect of which the whole nil whole nil has been allowed. So we will just disregard it. Other assets, in case of other assets, depreciation assets is WDV, but in case of other assets, you have to take into account the book value of the assets. So we will take up a small problem which will help you to make understand the problem. Okay, so I will explain the problem step by step, and we'll spend a lot of time on understanding the problem. Mr. N.S. Mehta, Messrs. N.S. Mehta and Company during the year 2019-20 disposed of its loss-making undertaking for a lump sum value of rupees 100 lakhs. So there was a unit which was making loss, and they thought of disposing this asset, and they disposed it for 100 crores or 1 lakh rupees 1 lakh rupees, or understood. So they sold it for rupees 1 lakhs without assigning value to individual assets and land. So for example, this is the undertaking. They have got land, building, plant and machinery, debtors, closing stock, furniture, and other things, and goodwill, etc., etc. So, and at the same time, they got liabilities like bills payable, creditors, so on and so forth. So, all the undertaking was sold without finding out the value of this individual items to a third party for rupees 1 lakh crores, 1 lakh rupees. Now, at that time, uh, when they have sold, the following details are given as far as assets are and liabilities are concerned. So from this data, we have to find out what is the value of the whether it is a what is a long-term capital gain or a short-term capital gain. Okay, so we will solve the problem. So the value land, there are assets: land, building, plant and machinery, furniture. There were inventories of closing stock. There was an element of debtors and creditors and bills payable. So these are all assets, and this is the liability, and they have given you the book value of these assets. So I will not go into the definition of book value of the assets. There is a separate topic. This is separate subject altogether. The book value of this land was 7,500 lakhs, whereas the market value is 10,000 lakhs. The building. So this is not a depreciable assets. So this is not a depreciable assets. Look at this. This is if it is a depreciable assets, then the WDV value of the block of assets is to be taken. In the other cases, other assets where it is not a depreciable assets, then you have to take book value of the asset. So in this case, land book value of the asset will be taken. Okay, and we will not take market value. So market value will not be taken at any point. So you ignore this. Building, building is a depreciable assets. For depreciable assets, we have been asked to take into account the WDV value of the asset. So here we got WDV value of the block. So building, the WDV value is 150. The book value is 1,000, 15,000 lakhs, but the WDV as per, that is written down value as of the block of assets as per IT Act, is 30,000 lakhs. So 30,000 lakhs. So this should not be taken. This should be taken as, I am again reiterating, for depreciable assets we have to take WDV and not book value or market value. But in case of a normal asset which is not depreciable like land, we should not take WDV because we don't have WDV for land, and neither market value. We should take into account book value. So hope you have understood. So third one, plant and machinery. Plant and machinery is an excellent case of an asset which is depreciable assets. And in case of depreciable assets, we have to take into account the WDV value and not the book value or the market value. So market value will not be taken at any case. So we have just discarded that. So for plant and machinery, neither the book value is taken, neither the market value is taken. For a depreciable assets, again I'm reiterating, you have to take into consideration for the calculation of a capital gain WDV value. That is written down value, which is 50,000 rupees. Furniture, we should not. This is also a depreciable asset, so we should not take into account this one, which is a book value, neither the market value, but you have to take into account written down value method. For depreciable assets, written down value method. For ordinary assets which are not depreciable, book value. In the same way, closing stock. So closing stock also you have to take into account uh, the the book value, and not the market value, because we are not selling selling. So it will not be realized. So we have to take into account for other assets apart from depreciable assets and non-depreciable assets like inventory and debtors and bills receivable, the book value. So we will take a book value of 5,000 lakhs. We will assign a book value of 5,000 lakhs to inventory of closing stocks at the time of sale, and to debtors and bills receivable we will assign 2,000 lakhs. Whereas these are all assets. Now the value of liabilities, will be again taken into account as far as book value is concerned. So please remember, one more item is given, that at the time of sale the broker has charged 10%. So let's solve the problem. So we have to find out, this is the normal method we have to follow. This is the normal method, that is sales minus transfer on cost, that is sales consideration, and then from the sales we have to deduct the expenses. Let's solve the problem. So already I have discussed land. Land is a non-depreciable asset. So we have to take book value, and which is given in the previous slide, 7,500 lakhs. So 7,500 lakhs is taken. So this is asset number one. Asset number two is inventory. Again, I told you you have to take uh, book value, which is 5,000 lakhs. So uh, you have taken 5,000 lakhs. But debtors, again book value 2,000 lakhs. So debtors 2,000 lakhs. Building, I told you to take WTV as per Income Tax Act, which is 30,000 lakhs. Plan and machinery also we have to take WTV as per Income Tax Act, and furniture also WTV as well. So these are all assets 1, asset 2, asset 3, asset 4, asset 5, and asset 6. If you total the total of assets, it is 95,500 lakhs. And from this, obviously, to find out the net worth of the company, which is the one which we are trying to find out for the purpose of calculation of capital gains net worth. So we have to deduct the liability. So there are liability should also be taken on the basis of the book value. So in this case, it is 15,500 if you look here. So 15,500 if you deduct, you will now get the cost of acquisition as 80,000 lakhs. 95,500 lakhs minus 15,500 lakhs, you will get 80,000 lakhs. So the cost of acquisition is 80,000 lakhs, which is the net worth. Now there's no improvement, so zero. So 90,000 lakhs is the sale consideration. From this, you remove the cost, you will get a long-term capital gain of 10,000 lakhs, assuming that it is a old company which is having more than 36 months of existence. So hope you have understood these problems. Tomorrow again we will join and discuss some more uh, numerical problems on different types of assets when they are sold. Hope you have understood. If you have any doubts, you can get back to me. Thank you so much for your patience listening. Bye bye. Take care. Have a good day.